Hi, my name is Roger Schlater. This video is actually about the business partnership agreement, and the business partnership involves a legal binding agreement between two or more parties. It's wise to talk to an attorney to assure that your agreement meets all the legal requirements and includes all the requirements that you want to include in this agreement between you and your partners. The country, state, or county laws can influence the partnership agreement and its specifics. This is just a general overview of the partnership agreement. I'm not an attorney, so I'm not giving you legal advice. But anyway, let's go ahead. Anyway, to define the partnership, well, that's what you want to do, is define it. You want to state the purpose and business activities of the partnership. State the duration and or the term of the partnership. You also want to identify the partners. State legal names and addresses of all partners. Also specify the percentage of ownership and the capital to be contributed by all the partners. Roles and responsibilities. Show the roles and responsibilities of all partners, including decision-making authority. Show how profits and losses will be divided between the partners. Show the contribution of each partner and what that contribution is, whether it's cash, a type of asset, or a type of service. Financial matters. Detail the financial parts of the partnership, like capital, loans, and banking details. Decide how the partnership will show accounting, financial records, and taxes. Make guidelines for distributing profits and losses. Management and operations. Show the management and structure and decision-making process in your partnership. Define the authority of each partner and figure out how disputes and conflicts will be addressed. A lot of times you also want an exit strategy. Make provisions for ending the partnership, including buyout, non-compete, and transferring ownership. Try to include ways to resolve conflicts with mediation or arbitration. That's usually a lot better than lawsuits. Governing laws and jurisdiction. You want to specify the country, state, and or county of laws and jurisdictions where legal problems will be resolved. And signatures. Make sure all partners sign with legal name and date of the documents on the documents. And this will indicate their acceptance of the agreement, so you really don't have to say too much there. And then always make sure you consult an attorney to address all the concerns and make sure the document is legal. Of course, you can use an online service to write almost any legal document, and the service will assure you that it is legal in your area. These are usually a fill-in-the-blank type document and may or may not protect the interest of your partners. Will be legal, but you may want some things in there to be addressed. The other thing about the partnership is, if you have a sole proprietorship now, the sole proprietorship is, most accountants say it has a 25% greater chance of being audited by the IRS. And whenever you look at a partnership versus a sole proprietorship, the partnership is audited much less than a sole proprietorship. And the sole proprietorship is really on your personal return. And the IRS says they love the sole proprietorships because they have found out in the past that usually the income and the expenses are usually, the income is usually less, and then the expenses are usually higher when they do the actual Schedule C for the sole proprietorship. So actually they really kind of go after the sole proprietorships a lot more. When you have a Schedule C as a sole proprietorship, or you have, on your tax return, even if it's an LLC and it's on your, as a single member, you can actually make an LLC, but you can still report on your personal return on your Schedule C. Those, they go after those just as much. I mean, if it is a Schedule C on your personal return, the IRS is going to look at that very, very closely, and they know how much most of these businesses make, so are supposed to make. So a lot of times they can tell if yours is out of whack So I'm just saying, you know, you can always have it even perfect and they can still audit you. So if you create a partnership, you actually fill out a partnership return, and that will go to your that income or loss will transfer to your individual tax return. But you get audited a lot less. I mean, I think the numbers were like the partnership gets audited like a 0.1, and the actual sole proprietorship on a Schedule C on your personal return is audited. I think the average is like up to 1.6, percent. So and these sounds like low percentages, but they don't audit that many, and so they're very high percentages, at least for the sole proprietorship. So anyway, please subscribe and hit the bell to notify you of upcoming videos. Also, please like the video if you learned anything from the video. My name is Roger Schlueter, and I will see you in the next video. Thanks.